Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, March 17th, and I'm recording this from my home in Ridgefield, Connecticut. Recent market volatility has seen the S&P 500 index gyrating around a 10% correction, while the NASDAQ is off about 12% in the last 8 weeks. While some of this has come from negative economic surprises and a hawkish pause by the Fed, more recent turbulence has come from a turnaround in investor sentiment based on surging policy uncertainty. Confidence matters to consumption and investing, and it has been deeply shaken. This dynamic, plus rising inflation expectations and stagflation potential, has led many forecasters, including Morgan Stanley and Co.'s research department, to reduce their real GDP growth estimates for 2025 and 2026. At this point, for many investors, a resumption of the bull case rides on a pivot in Washington's agenda towards deregulation and tax cuts. Now, we should note that we're encouraged by the potential for deregulation to support growth in sectors like financials and in energy. However, we're more skeptical of the stimulative power of tax cuts, given that the political and economic realities increasingly suggest limited genuine progress on ultimate debts and deficits. In particular, our caution about incremental stimulus is premised on several observations. First, the Republican base case is that a simple extension of the existing tax law for the next decade would cost about $4.5 trillion, with congressional authorization seeking $1.5 to $2 trillion in offsetting spending cuts. Some of that is unidentified and may be sourced from the efforts of DOGE, while other portions may need to come from Medicaid or Medicare. But these are politically popular programs, suggesting weak prospects for achieving the high end of cuts. The implication is that even in the best case scenario, that progress will be limited in the 10-year debt and deficit forecast. Second, there are suggestions that growth stimulus will come from extra promised tax cuts, such as the lifting of the SALT cap and eliminating taxes on tips, Social Security, and overtime. The problem here is not simply the sheer cost of these promises, but the congressional requirement that they come with pay-fors. Not only will they be difficult to find, but they will also come with negative implications for the economy, given what we call high fiscal multipliers. These multiplier metrics aim to explain the effect of a $1 change in budgetary cost on outputs. Negative impacts on this front are unlikely to be offset by the positive effects from tax cuts to higher income households and corporations because they are chronically net savers. Finally, there's the issue of tariffs as revenue enhancers. It is estimated that 25% tariffs on Mexico and Canada and a 10% cross-the-board tariff on China, if fully and persistently implemented, could raise about $120 billion a year in new revenues. That is a significant number, but there are reasons to be skeptical. Given the president's negotiating style and history, we've already seen a willingness to frequently make changes and exceptions. Also, likely 50% of the imports from Canada and Mexico will be deemed to be compliant with the USMCA existing treaty and therefore not subject to the just announced tariffs. Most importantly, these revenue estimates do not account for the negative impacts of global retaliation or potentially weaker import volumes. So considering all this, it is too soon to call the all clear. Markets are likely to remain volatile and idiosyncratic, where risk management will remain paramount. Consider being opportunistic and adding some stable growers in software and in healthcare. And look also to consumer services like media and cyclicals like financials. Continue to diversify regionally across emerging markets, Japan, and select European names, funding from long duration rates. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.